So this is a question on convertible loan notes, but it is actually compound financial instrument. A compound financial instrument is just a financial instrument which has the characteristics of both what? Equity and liability. So I mentioned that when an entity issues a convertible loan note, that becomes what? A compound financial instrument. So we need to split it into the equity component and then the liability component. Now, how do we find the liability component? I mentioned earlier that the liability component is the present value of the cash flows, you remember? Cash flow using what? The interest rate of similar bonds without the conversion rights. Back to what we are doing. So, to find the liability component, we calculate the present value of the cash flows using the interest rate of similar bond without the conversion right. Then to get the equity component, we said it should be what? The proceeds minus the liability we calculated. Right. So it is this idea that will guide us for the initial recognition of this particular convertible loan note. So initial recognition. Now there are other items in the question. So for the sake of, so let me just read through the question again. What was the name of the company I used? I don't have company name. What company name did I use? ABC. Okay. What was the company name I gave you? XXS. Okay. We are sure the company name. So on January 1, 2018, XYZ Limited issued a 50 million 3-year convertible bond at par with the following terms. Issue cost amounted to what? $500,000. The coupon rate is 10% payable annually in arrears on 31st December. The bond is redeemable at par on 1st January 2020. Bondholders may opt for conversion. The term of the conversion is 2 25-cent share for every $1 owed to each bondholder on 1st January 2018. Bonds issued by similar companies without any conversion rights currently bear interest at what? 15%. The impact of the issue cost is to increase the effective interest rate to 15.425% required. How should the company account for the bond? Assuming A, the bondholders opt for conversion, B, the bondholders opt for cash. So how do we go about it? As I said, anytime there is a convertible loan note, then it is a compound financial instrument. So we need to split it into the equity component and then the liability component. So how do we do that? We will first calculate the liability component by discounting the cash flows using the interest rate of similar bonds. So we're going to put a schedule down, okay? And we're going to have year here. We're going to have cash flows here. We're going to have the discount factor. We're going to have present value. Listen carefully. The discount rate is what I said using the interest rate of what? Similar bonds without a conversion. And that is 15%. Sounds good? The cash flow, you are going to use the coupon rate on the bond, which in this case is what? 10%. Very important. So let's go. We're going to have year. So we have 2018 because it was 1st January. So the year ended with 2018. How much will come? 10% of 50 million. We are working in 3 zeros up. So it will be 50,000. What do we have? 10% of 50,000. How will 5,000 I guess? 5,000. Now listen carefully and follow me. 2019, same. But in 2020, it will be redeemed. So in 2020, the redemption, the nominal value of the bond plus the interest. So here will be 55,000. Are you following the picture? It will be redeemed after the third year. So in the third year, the interest and the nominal value of the bond will come in. Please note, assuming the redemption was done at a premium, that means they will redeem it over the nominal value of what? 50,000. This is at par because we are told that it is issued at par. So if they are redeeming at a premium of say 10%, Acca, it means on redemption they will get 55,000 plus the interest for the year 2020, 5,000. We would have brought 60,000 here. I don't know if it makes sense. That's it. I should rewind.
I thought it's the 5,000 we added to the 50,000.
To get a 25,000. The 5,000 is the interest for 2020. Are you getting it? But the nominal value of the bond, the value they will redeem it at, will have to be brought. And in this case, it's 50,000. And I'm saying that, assuming they are redeeming it at a premium of say 10%, premium means you are redeeming it over the nominal value. Hence, we will calculate 10% of the nominal value, add it to the nominal value, making 55,000. This is the money they will get. Plus the interest we would still pay in the year 2020. So in that case, it will be 60,000. Does it make sense now? So that is what will happen. But in this case, this is not there. I'm just bringing it up because, as I said, we can't do everything in a question. So let's come here. Discount rate. 1 divided by 1.15. 1 divided by 1.15 exponent 2, 1 divided by 1.15 exponent 3. I hope you know why I am writing these things up. Because discount rate is 1 over 1 plus r exponent what? N. And 1 it will help me out with the discount factor. Okay, just multiply and give me present value. Four, 3, 4. So to the nearest 1,000. So 4348. Next one. Three seven eight one. Three six. So add the 3. That will give us the present value of the cash flows. Present value of the cash flows. 44,292. Now follow me carefully. This present value of the cash flows becomes the debt component. Which is what? The liability. So how do we get the equity component? We bring the proceeds, and the proceeds is 50,000. And so the difference gives us the equity component. So what do we have? So let me present it properly. Proceeds 50,000. So the balancing figure will become the equity component. What do I have? 5 So that is the thing we do about separating the thing into its debt components and the equity component. Please be careful the discount rate we are using. It's very important. You are using the discount rate of similar debt without the conversion rate. That is what you're using. The cash flow is the coupon rate. Effective rate is higher because you have November later on. Now, if there was no issue cost, then we wouldn't have done anything. We would just carry this out and debit cash with $50,000, credit equity with 5708, and then credit the liability with what? 44292 in the balance sheet. If there was no issue cost, this is what we would have done. But in the question, the examiner said there was an issue cost of 500,000. So how do we account for the issue cost? We share the issue cost or apportion the issue cost between what? The equity and then the debt. So allocation of issue cost. So we're going to bring equity here, we're going to bring liability here, and we're going to bring total here. So give me proceeds. What was the proceeds? 50,000 total. So debt equity component was 5708. Liability component 44292. Then we are going to less the issue cost. Sometimes it is also called the transaction cost. The total issue cost was 500,000. So we share. So how do you share? 5708 divided by 50,000 times 500. Then you get a portion for this guy. To the nearest 1,000. 57. Okay. Next one. Okay, you subtract that one since you have a 57. Good. To the nearest 1,000. So when you subtract, good. 43849. Good. So look at the steps carefully. First, we separate the whole proceeds into its debt component and liability component. If there are issue costs, this is how we share it. So after that, the initial recognition, it's going to be 1. We debit the cash with 50,000 about the proceeds. We credit equity with what? 57. Okay, I've already done that here, the first part. So let me just deal with the second part here. So we debit equity with 57. Remember, we're working in 1,000. We debit equity also, liability also, with 443. Then we'll credit cash with the 500. So this is the initial recognition. This is the initial recognition. If the examiner brings you a compound financial, so the examiner will not tell you it is a compound financial instrument, right? The reading of the question, once it's a convertible debt, convertible loan, convertible debentures, you have to note that it is going to be a compound financial instrument. So that is the initial recognition. So the bond being redeemable from 2021. Next one. So after initial recognition, we go to subsequent measurements. Subsequent measurement. So how do we go about this? The debt component will be carried at amortized cost. Okay? So subsequent measurement, the debt component will be carried at amortized cost. So this is where your amortized thing comes to town. So when it's being carried at amortized cost, how do we treat it? So we put our pro forma down again. We have here, we're going to have opening balance here. We're going to have the interest here. We're going to have the cash paid here. And we're going to have the closing balance. The opening, the interest, the cash paid, the closing balance. Now, stay with me here well. Still, we are working in thousands. Now, the interest we bring here is the effective interest rate. Okay? So the interest we're going to be charging here is the effective interest rate, which is 15.425%. The cash paid here is the coupon rate, which is what? The 10%. Sounds good? So I want you to look at the build-up and how the treatments are being done. So let's go. Now, why did we do this arrangement? Because if you go back to the question, we were told that coupon rate is 10% per annum, annually, per annum, in arrears on what? 31st December. So the interest will be paid at the end of the year, meaning we will charge interest on the opening balance before we pay. If the interest was paid at the start of the year, then the cash will come before the interest will come. You listen to that very well. Okay, so this is why we did this arrangement. So let's go about it. Year one. So what will we have in year one? That's 2018, yes. So in 2018, what do we have? Okay, so let's put the years up so we don't confuse. 2018, 2019, 2020. Can I have an answer? Now, the opening balance will be that figure we got here after deducting the issue cost. That is the amortized cost. How much is it? 44,292. So now, let's go. 15.45% of that figure. Oh no! What figure did we bring here?
I thought you said it stands at the end.
No, it should be the amortized cost, the real value that we had at the split off point. We won't take into consideration the issue cost, sorry. The debt component we had at the initial stage. How much was it? Do you understand what I'm saying? No, not 50,000. The present value of the cash flows we had. How much was it?
That's the 44,292.
No.
Present value of the cash.
Yeah. Was that the 44,292? That was the present value of the cash flows.
Yes.
Then after the issue cost, what did we get?
We had 43849.
438. After we deducted the proceeds. So now this is how much we are going to carry on the liability, isn't it? This is how much we will carry the liability. So that is what we have to use for it. 43849. So please get this well. We've deducted the issue cost. So now this is how much we will carry it in our books.
Yeah.
So it is this that will become what? The opening balance. So 15.452%, what do we get? Quick, punch with me. So so I don't take much time. To the nearest thousand. 6776. Then what was the interest? 10% of 50,000, so that will be 5,000. So no problem. So do the workings for me. This plus this minus this, we get a closing balance.
What do you charge 10% on the
Nominal. Yeah, because that is the nominal value of the bond. That is how much interest we'll be paying every year. Because the people,
because we divided it into the equity and the liability.
they don't care. That is your division. They will still receive the coupon rate on the whole 50,000. How we are getting the idea? So we were going to be paying you what? The 5,000 out every year. So your division doesn't affect the interest you are paying every year. That's something you need to understand. So that you were thinking we will do 10% of this figure as the cash paid. No, it is the whole thing. Because the whole thing you issued is the whole value of the bond. So what do I have? Arithmetically. Way plus way minus way. Someone say way negative, cash you paid. So this plus this minus this. 45625. Now stay with me closely. The closing becomes opening here. 45625. So get 15.425% of that. 7038. Still, we will pay an interest of 5,000. So let's get a year-end value. $47663. Good. It becomes the opening for 2020. 47663. Give me 15.452%, 425% of that. 7352. Then we will still pay an interest of 5,000. What do we have? So it's like 50,000 approximately, right? 50015. Yeah, so approximately it should be 50,000. Now, what does this mean? So this is what I want you to understand, and this is where the thing is. This is what the examiner is asking you to do. So at 1st Jan 2021, the carrying value of the convertible loan will be the debt 50,000, the equity. What was the equity component? 5651 after the issue cost, making a total of what? 5651. Sorry, 55. Hey, am I right? Am I right with that answer there? Yeah, 55651. Now listen carefully. This is now the value of the bond at 2021. And the examiner, they said, what will happen if they opt to convert? So let's look at what will happen and how we account for this on conversion. In the happen I hear back question, no, they are in a freestyle. So on conversion, what was the terms of the conversion? What was the terms? 25 shares, 25 cents share for each $1 owed, isn't it? So you're going to get, so to get a number of shares that they will get, listen carefully. You will get 2 shares for $1 we owe you. So how many shares will you get if we owe you 50 million? How many shares will you get? Times 2, isn't it? So number of shares becomes 2 times what? 50 million, and that will become 100 million shares. Are you following the idea? But what is the value of this 100 million shares? So value of shares. we are told that the value of the shares will be 25 cents. Hence, $0.25 times 100 million. Can I have an answer? 25,000. Now, let's work in thousands. We are working in thousands, so let's keep it in thousands. So let's do this guy 100,000. Let's do this guy 100,000. Now, look at it carefully. Look at it carefully. When they convert, I want you to look at this carefully. When they convert, this is the value of the shares. But they are bond, no value. So what do you think will happen to the entity when they convert?
The entity
It will gain. And what is the gain? What is the name of a gain on issue of shares? Share premium. Share premium. So what is the double entry here? And this is where I want you to get. So meaning that the value, the difference would be taken to share premium, which is this guy, 55,651 minus 25,000. What do I have? Three zero. Inti, then I am a double entry. We debit, look at it carefully. We're going to be debiting the equity with this figure. So it goes 5651. We will debit liability with this figure, 50,000. It is no more. Then we now credit share or equity, or if you say share capital, with how much? 25,000. Then we credit again share premium. How much? 30,651. Do you understand? This is what happens on the conversion option. Option 1. Sounds good? Looks simple? It looks simple, right? So be careful. Be careful. First, you have to calculate the number of shares they will get on the conversion. Boom. Then, what is the value of the shares? We are told it is 25 cents share. So, we multiply, then we get a value. Okay, if you compare how much they are getting and how much their bond is worth now, as at that date, definitely it will lead us to Ifrs, and then Ifrs is what we call share premium. Then you need to remove them from the books. So you debit, and now you credit share capital and share premium accounts. Look at the flip side. ICAG on redemption. If they take their money, what will happen? If they take their money, what will happen? Look at what will happen. It's a simple thing. If they are taking their money, how much would they take? A liar has a tail. If they are taking their money on redemption, if they are taking their money, how much would they take?
55651.
A liar has a tail. Go back to the question. What were we told that it will be redeemed at? The bond is redeemable at what? Par. So how much will they get when they redeem? 50,000.
So at that means
the nominal value of the debt. Are you getting it? See, you did it. All the calculation we did, these four things and those things, was for our accounting purpose to separate it between the equity and what? The debt. But to the bondholder, what did they carry? 50 million. It is Oba Betty the 50,000. It is Oba Betty 50,000. Now what do? We're going to be debiting the debt or the liability account to take out that 50,000. Okay? Then we will pay. So we will credit the cash with 50,000. Yeah, but you will see that if we pay them this, the equity is still having 5651. The standard says that this thing will be classified as undistributable reserves. In other words, we don't take it out from the book. It will be there and classified as undistributable reserve. Meaning, from this 5651, we can't pay dividend. It will just be carried. Later on, if we add more reserves, we can issue it as shares to the company, to the owners of the business. That is how we do it on redemption. So the equity balance of 5651 is classified as undistributable reserve. Boom. There you go. Madam.
What I don't understand is
Yes.
how they give us 50 million, 50,000, 50,000.
Yeah.
And all of a sudden we have to pay back 1,000 and then they still have 5651 as well.
Yes. It's because we have
So
separated.
does that mean that the 5651 in reality is the interest?
So get a concept. Anytime we issue convertible loan notes as a financial instrument, the standard says that we must classify it into the equity component and the liability component. So that is step one. When we calculated, the 50,000 has been split into debt and equity component. Then when we finish, the subsequent measurement is that the debt should be carried at its what? Amortized cost. Hence, we come to this table and look at the subsequent measurement so that we can determine the value of the debt as at the end of the 20th years. Taking into consideration the effective what? Interest. So at the end of the third year, the value of the debt is 50,000. And they will redeem their debt at par. So how much do we owe them? We owe them 50,000. 80-year categorization, and they need here to have this benefit of 5651 in our books. So the bondholder will still take his 50,000 away, but reserves by virtue of the fact that we've issued convertible loan notes to increase our status. Alright. So that is why we do that.
Effective interest rate. That is when you want to amortize the debt component.
Yeah.
That is when you use it.
Yeah, the effective rates. So in effect, we are not paying this, we are paying this. That is the idea. So we are not paying this, we are paying this, taking into consideration the issue cost. So the issue cost is being spread over the life of the bond. So that is it about that. So that's what you have to understand about compound financial instruments. If you have any questions, you put them in the comment box and I will answer all those questions. If there are any topics also you want me to cover, you can suggest that also. Remember to share this video and subscribe to my channel and make recommendation for it. You can check the screen. There are other suggested videos that you can watch on accounting standards as well as on consolidated financial statement. So I'll see you in another video as we talk about another accounting standard.